Welcome back to Weekly. Joining me now is Professor Robert Shiller, a man who needs no introduction. Professor Shiller, thanks for joining me on Weekly.
My pleasure.
So, Professor Shiller, you're in Toronto to help BMO launch an ETF. The ticker is Zeus, and it's the Shiller Select US Cape Ratio ETF.
Right.
Please tell me about the strategy.
I think it's an improved value strategy by combining both an improved measure of value and also a tilt toward older companies. I think the value strategy has always suggested that the new companies are more likely to be faddish. Old companies that have been around for a while and are underpriced.
So aside from any potential constituent to the ticker Zeus ETF that has been around a long time, what's the methodology for selecting the securities?
Well, we go through stocks to find liquid, not small cap stocks, and then look among the individual, and they have to have been listed for at least 20 years. Then we go among them, that makes them old standbys. We go among them looking for those with the lowest CAPE ratio, which is the ratio that I and my student John Campbell developed 30 years ago. It's a measure of overvaluation. We pick the lowest CAPE stocks. And then we also have a momentum correction.
Now, since 1881, the CAPE has averaged 16.8, and CAPE stands for cyclically adjusted price earnings multiple.
Correct.
So the average has been 16.8. Only twice in the past, 1929 and 1997 through 00, has the multiple been above 30 times. And as our viewers can see on the graph on the right-hand side, it's a third time since its 1881 launch that it's trading above 30, currently 31 and a half times at this point in time. But you yourself point out that while that is a message of overvaluation, it's not a perfect predictor.
Yeah, when I testified before Alan Greenspan in the Federal Reserve in 1996, the CAPE was somewhat close to where it is now. But I didn't call it a market turn then. I'm not going to call it now because value investing doesn't tell you when the corrections will come. It took 3 years for it to come after 1996.
Well, it's interesting you mentioned Mr. Greenspan's name because, of course, he uttered a phrase during 1996 that became the title of your March 2000 book, Irrational Exuberance. Right. And in that book, you wrote that there was impressive evidence that the price level of the stock market is based on more than just economic information. Right. And now, as you look back on that statement, 17 years later, with the explosion of information and misinformation that's out there, would you adjust the statement? Do you think the market's any more efficient today than it was then?
Well, the general presumption has been that markets get more and more efficient through time because learning keeps adding to our body of knowledge, and we get an increasingly professionalized expertise. But there are things that can offset that. New fashions and fads can appear, and it takes a while for us to understand how they operate. Also, there's been a trend toward passive investing, which is pulling some of the good judgment away from the market.
ETFs, for example.
Yeah, if people are freeloading on the decisions of others, that can work for a while, but eventually there's going to be discrepancies that come up. So we are, with the BMO Zeus product, we are trying to systematically offset the impact of these discrepancies on our portfolio.
Well, your comment about market psychology, investor psychology, one of your many indices shows that investor confidence towards stocks is the lowest it's been since the year 2000. Right. Kind of ironic when you think of it. But at the same point in time, the psychological conditions for a steep decline, according to you, aren't necessarily there either.
Yeah, we're talking about psychology here, right?
Yeah.
This is what goes on between a psychotherapist or a psychiatrist. And economists resist talking about things like this. But I'm talking here about human judgment. I compare this episode with, I wasn't born in 1929, but I can read the newspapers from the time. I was around in 2000. And I have a sense that we're not as edgy about the market, which means we're less likely to panic sell if there's some initial decline. But I don't mean that to say that it can't happen. It can happen. Public attention can be drawn to things suddenly and dramatically, depending on what's going viral. I wrote my presidential address for the American Economic Association on narrative economics, which I just gave recently. Stories drive markets. And so efficient markets is not an accurate theory because these stories keep cropping up and investors have to wonder what to make of them.
And of course, that's one of the big problems about trying to time the market. You don't know which story on what day of the week is going to be that catalyst.
Yeah, going viral is a bizarre phenomenon. It's very hard to predict what will go viral. It has to have some kind of human interest, maybe some scare factor, and suddenly people can be responding to even fake news that has no basis in fact.
And sometimes it comes out of the bulge bracket dealers on Wall Street, but they don't seem to be talking about irrational exuberance. Is that because they're talking their own book or because they don't know what to say?
See, what I like to do is count the number of, you can do it on a computer now.
Right.
Irrational exuberance peaked in 1997. Of course it did. It was a year after the Chairman Greenspan's talk. And it kind of picked up a little bit around 2000. People were starting to worry about irrational, and it's been trailing off. I think it's picking up a little bit now, though, and we'll probably see more talk about irrational exuberance in coming years. I'm not sure exactly when.
Thanks very much, Professor. I'm chatting with Professor Shiller on Weekly. After the break, we're going to talk more about markets. Welcome back to Weekly. I'm chatting with Professor Robert Shiller. Professor Shiller, your most recent book called Fishing for Fools, and that's not spelt with an F, it's spelt with a PH. You write about how people get played for fools, how they get manipulated. What are some of the biggest fishes that you see out there at this point in time?
Well, we use the word fish metaphorically.
Right.
It's not just limited to computer schemes, internet schemes. What comes to my mind as a sort of fish is the Bitcoin phenomenon. It's big because it went viral. Why did it go viral? I think it's because of a story. Now, I don't know if it was deliberate in this case. Maybe it was. This supposed genius, Satoshi Nakamoto, issued on some kind of chat room a plan for a new digital currency that excited people. It sounded like I don't know how young people put it today, a cool idea.
Right.
And it followed a classic bubble pattern. Why would anyone pay attention? If no one paid attention to it, it would have gone nowhere. But it's paid attention to because the initial investors were making a lot of money. And then people started asking, who is Satoshi Nakamoto? Now, I could ask you if you had him on your show, but I know you didn't because he doesn't exist.
Right.
It seems like nobody can find him.
Speaking
so
about fishing for fools.
Yeah, where did this come? It has a mystery quality. And people like stories like that. It towers over the other cryptocurrencies because it has the story.
Well, is it logical that authorities, be it monetary authorities or governmental authorities, will allow cryptocurrencies to grow as they appear to be wanting to grow, given that it seems to be a license for fraud and manipulative activity?
Right. The governments can do something to inhibit the growth of these cryptocurrencies, even though they seem to be beyond the pale of government.
Would you assume that they would at a point in time?
Well, one thing is that they can be used in their present conformation. They can be used for illegal activities to evade, and we start becoming concerned about the illegal activities. just like cash. Ken Rogoff wrote a book recently advocating eliminating large denomination bills because that will help reduce crime. If the criminals have to carry suitcases of $5 bills around, then it's going to be harder to commit a crime.
Well, it's funny you make a joke about whether that non-existent person's been on my show, but later this year I will be doing a show on cryptocurrencies. And one question that I have is if they keep growing, whether or not their growth will decrease the utility of gold as an investment.
Gold is an interesting case because it is itself a very long-lived speculative bubble. Why does gold have value? You might be digging sometime and you'll find little specks of something yellow in the dirt. Now you might think, well, what's that? It doesn't mean anything to me. But somehow people decided it was money. Okay. And that hasn't gone away in thousands of years. So viral epidemics of ideas or stories can last for thousands of years. So I can't say with confidence that Bitcoin is going to go away. Even though it's got all these competitors, it stands over the competitors just because of the story.
And now coming back to markets and them climbing a wall of worry for who knows how much longer, given that psychologically investors seem to continue to be constructive, notwithstanding how they filled out your survey. So with the economy in decent shape and a relatively dovish Fed, excluding an exogenous shock, I'm thinking that either inflation must move higher to push interest rates higher, or quantitative tightening must cut liquidity so as to increase volatility. In other words, interest rates go up a bunch more than the market can handle, or volatility goes up enough such that systematic investing strategies have to go the other way, and if markets start falling, they push markets even lower. What are your thoughts?
Well, that seems to be a good analysis for what might happen. You painted a scenario. It's more than might happen. I think it seems pretty likely that volatility will go up and interest rates will go up because they're both at historic lows. The question is, how much will the markets react to them? And your story sounds plausible, but I never have certainty about stories like that. One thing that comes to mind is it could be a completely different story that drives the next. It could be little more than a reaction to price drops in the market and some fake news about something we can't even think of now that is thought to be driving it.
And now, when markets do get rockier, there's an estimated $2 trillion worth of investor capital that is in either passive strategies. I mean, not all the ETFs are passive, but allow me to characterize ETFs as passive strategies, and systematic strategies. In other words, the type of investment strategy that a gentleman like Ray Dalio at Bridgewater utilizes. And so, again, when markets go down, isn't the exit door going to be a little narrow for all this capital to get out? And does that exacerbate things?
Yeah, you're painting a scenario that I find troublesome. I don't. It's also remember that passive investing is a free riding strategy. It's like everyone else is cleaning up, but maybe I don't have to because they've done the cleanup. Maybe everyone else is trying to reduce carbon dioxide emissions, but I don't have to because they're doing it. But that doesn't. It loses its impact if people are doing it less and less.
So how do you hedge your equity book if you're an investor? Because in the past, you would own some bonds because when stock prices went down, bond prices would tend to go up. But with bond prices also at record highs, in other words, yields at record lows, bonds don't seem to be a hedge to an equity book today. What does an investor do?
Well, I think that you talk about equity and bonds. The correlation between returns on equity and bonds has changed sign many times. In fact, there was one study, it's changed sign 29 times from 1927 to 2012. So I don't know that it's that reliable. It never was that reliable a hedge for the stock market. I think hedging, diversification has to have some kind of common sense. We'll hold assets that are logically less connected and hope that the prices will also be less connected.
And it doesn't sound like buying a house or two in Toronto or Vancouver would be a hedge for you at this point in time.
I am not planning on buying a house in Toronto or Vancouver.
Why? Because you don't like the weather, or it's just too expensive?
I look at the plot, the Terranet plot of home prices. Wow, they're really, what's going on? What are you people thinking?
Look, liquidity makes everything marvelous, doesn't it?
Yeah, well, the low interest, but we have low interest rates in the U.S. and our home prices are not going up so fast. Neither are home prices in other parts of Canada. It's an urban effect. It's something about these two centers and maybe a few other places. So it's belief in urbanization and intellectual business prowess, something like that.
Thanks very much, Professor.
My pleasure.
I've been chatting with Professor Robert Shiller. After the